Most traders don't blow up because they're stupid. They blow up because they're restless. They can't tolerate silence on the screen. You've lived this yourself. You start Monday morning with discipline and a clear plan. By Wednesday afternoon, you're clicking buy and sell buttons like a slot machine addict, taking 12, 20, even 30 trades per day, believing that more screen time must equal more money. You go to bed exhausted, wired, and secretly unsure whether you're actually progressing or just spinning in expensive circles. The overtrading epidemic has a specific anatomy. It begins with boredom. You're watching the charts, price is moving, but your plan setup hasn't triggered. Your brain starts rationalizing. That 5-minute pattern looks decent. I could catch a quick 20 pips. You enter. Sometimes you win, sometimes you lose, but the real damage isn't the money. It's the psychological precedent you've just established. You've taught yourself that feelings of boredom or FOMO are valid reasons to risk capital. Within weeks, you're no longer executing a strategy. You're managing anxiety through market action. Trading becomes your drug, and the market becomes your dealer. Every losing trade creates emotional pain that demands immediate relief through another trade. Every winning trade creates a dopamine spike that makes you crave the next hit. You're trapped in a cycle where the activity itself matters more than the outcome, and this is exactly where the market wants you, because undisciplined, emotional traders fuel profitable institutional positioning. Here's the brutal truth that separates amateurs from professionals, and it might hurt to hear. If you can't make money taking one high-probability trade per day, you won't make money taking 10. More trades don't fix bad discipline. They multiply it. The amateur wakes up asking, how many trades can I take today? How many moves can I catch? The professional asks a different question. Is there one asymmetric opportunity worth my capital today? That single question reveals everything about your identity and whether you'll still be trading next year. Jesse Livermore, who made millions in the early 1900s when millions were worth billions in today's money, understood this deeply. He said, "It was never my thinking that made the big money for me. It was always my sitting." Think about that. Not his genius, not his predictions, not his magical indicators. His sitting. His willingness to wait for what he called pivotal points where the market showed its true intention. Most traders today do the opposite. They can think, they can analyze charts, they can draw support and resistance lines, but they cannot sit. This inability to endure the psychological discomfort of doing nothing while the market moves without them is what keeps 90% of traders from ever seeing consistent profits. Your biggest edge is not your entry signal. It's your ability to do nothing 90% of the time. In this training, I want to give you a different blueprint. We're going to dismantle the day trading addiction and replace it with a sniper methodology. One trade per day on the 1H chart. Not a fantasy of flipping hundreds into millions. Not some secret pattern that never loses. A mathematical process that can realistically scale from $20 wins to $500 daily income through the boring, repetitive power of compounding. But here's what most people refuse to accept, and why most will click away before learning the secret. To reach those $500 days, you must first master the most uncomfortable rule in trading. Waiting is a position. When your capital is flat and your risk is zero, you're not missing out. You are in a strategic cash position, preserving ammunition for the trade that actually matters. The 1H time frame is your psychological ally, because it naturally filters out 80% of the random noise that seduces day traders into bad decisions. Those tiny spikes and fake-outs that stop you out on the 1-minute chart become irrelevant blips on the hourly candle. You see structure instead of chaos. You see genuine pivotal points instead of algorithmic noise. Let me show you two traders with identical strategies and the same starting capital. Trader A lives on the 1-minute and 5-minute charts, scanning for opportunities all day. He takes 12 trades on average. His risk per trade is inconsistent, sometimes 1%, sometimes 4%, sometimes just a little more to recover losses. Some days green, some red, but always the same emotional state, tired, tense, confused about whether his edge even exists. Trader B focuses on the 1H chart. Before the session starts, she marks her pivotal levels. She knows exactly where price needs to go before she's interested. She has one clear setup she's allowed to trade. She risks a fixed percentage every time. Some days she gets her trade. some days none. On flat days, she doesn't drop to lower time frames to find something. She protects her process integrity. Fast forward 6 months. Trader A has had explosive days and devastating streaks. His account is down 35%. More importantly, he no longer trusts himself. Every morning he promises discipline. Every afternoon he breaks it. Trader B hasn't had fireworks, but her equity curve looks like a staircase instead of a roller coaster. She's up 18% and quietly increasing position size because she's proven she can follow her own rules. Same market, same tools, same access to information. The difference isn't intelligence or capital, it's identity. Trader A thinks, I'm here to win today. Trader B thinks, I'm here to survive today, so I can compound this year. That identity shift determines which setups you take, how you size positions, and whether you'll still be trading when real opportunities arrive. In the next chapter, we'll translate this survival-first mindset into precise mathematics. You'll see exactly how one disciplined trade compounds into $500 days, why professionals think in R multiples instead of dollars, and how this single shift can take you from hoping to knowing what your edge actually is. The numbers don't lie, but they only work for traders who can sit. Let's strip away the fantasy and examine what actually makes trading accounts grow. Most traders open their platform thinking, I need $500 today, or I want to hit my weekly target of $2,000. That desperation corrupts every decision, because you're now trading for external validation rather than executing a mathematical edge. You've turned trading into a job where the market owes you a paycheck, and the market doesn't care about your bills. Professionals operate from a completely different mental framework. They think, I risk 1% to make 2 to 3 R. Repeat. This shift from dollar targets to risk units is the most important psychological transformation you'll ever make in trading. It removes emotion from position sizing and replaces hope with probability. Let me define R, because this single concept will change how you see every trade. R represents your risk per trade, expressed as a fixed percentage of your account equity. If your account is $2,000 and you risk 1%, your R equals $20. That $20 is the maximum you lose on this trade if you're completely wrong. Not $19, not $25, exactly $20. I know what you're thinking. $20 feels pathetic. You can't live on $20. It feels like a waste of time to sit in front of charts for hours just to make $40 on a 2R trade. That contempt for small beginnings is exactly why most traders fail. They lack the humility to start small, so they try to skip the mathematical progression. They ramp up risk to make trading feel significant, but their account size cannot support that ego. A clean 1H setup with a 2R target means you risk that $20 to potentially make $40. Not exciting, but that's the point. You're building a systematic wealth-building machine, not chasing jackpots. You're becoming a factory that produces R multiples, and the factory owner who produces consistent R multiples eventually gets wealthy, while the gambler swinging for home runs eventually goes broke. Here's how the mathematics of compound patience actually work. As your account grows from consistent execution, your position size naturally scales while your risk percentage remains constant. You don't need to find better setups or develop supernatural skills. The same boring process that made you $20 per trade will eventually make you $500 per trade, simply because your capital base has grown. Watch this progression unfold. You start with $2,000. Your R is $20. One 2R trade nets $40. When your account reaches $5,000 through consistent execution, you're still risking that same 1%. But now your R is $50, making 2R trades worth $100. At $10,000, your R becomes $100, making 2R trades worth $200. At $25,000, your R reaches $250, making one 2R trade worth $500. The structure never changes. Your discipline never changes. Your emotional stress level never changes because you're still risking the same percentage. Only the position size grows with your capital, and that growth happens automatically if you protect the process. Let me show you why this matters through a comparison that plays out in real accounts every month. Trader A starts with $2,000. He's aggressive. Maybe he's had some early wins that convinced him he has special talent. He risks 5 to 10% per trade on high-conviction setups. When he loses, he revenge trades to recover immediately because he can't tolerate being down for the day. 3 months pass. Trader A has spectacular wins that make him feel like a genius. But he also endures losing streaks. During one particularly brutal week, he loses 4 trades in a row at 8% risk each. The mathematics are devastating. He's down 32% in 5 days. His $2,000 account is now worth $1,360. To get back to break even, he doesn't need a 32% return, he needs a 47% return just to recover. The recovery math has turned against him, and he's trapped in a hole that requires miracles to escape. Trader B starts with identical capital and market access, but she's structured differently. She risks exactly 1% per trade, no exceptions, no emotional overrides. She focuses on clean 1H setups and aims for 2R every time. Her win rate is nothing special, just 50%. Half her trades win, half lose. Let's run the mathematics over 100 trades. 50 trades hit her stop loss, 50 trades hit her target. 50 losses times 1R equals negative 50R. 50 wins times 2R equals positive 100R. Net result, positive 50R. At 1% risk on a $2,000 account, that's 50% account growth. Her account reaches $3,000. If she had risked 2% with the same results, she'd have doubled her account. Same win rate, same market, different discipline. This is how $20 trades evolve into $500 trades, not through bigger bets, but through consistent execution as capital compounds. Here's the critical insight that separates mindsets permanently. Amateurs obsess over dollar amounts. Professionals obsess over R multiples. When you wake up thinking, I need $300 today, you've already lost, because you'll force trades to hit that arbitrary target. When you wake up thinking, I'll risk 1R for 2R if my setup appears, you're in a completely different psychological state, patient, selective, and outcome independent. Thinking in R creates emotional detachment that's crucial for execution. When you're staring at a trade thinking, that's my rent money, you create fear that will cut your winners early and let your losers run. But when you think, I'm risking 1R to make 2R, you're managing an abstract number. It becomes a video game score rather than survival money. This detachment allows you to execute with the cold precision that profitable trading demands. The dollar amount becomes irrelevant because you understand the mathematics will handle scaling automatically. You're not trying to make $500 per day with a $2,000 account, which would require insane risk. You're trying to make 2R per quality trade, and letting compounding gradually increase what 2R represents in dollar terms. When you finally reach the level where 1R equals $500, you won't be shaking or sweating because you'll have spent hundreds of trades practicing with $20, then 50, then 100. You'll be desensitized to the dollar amount because you're hyper-focused on the process. Stop looking at your small account with contempt. Master the $20 risk. If you cannot execute flawlessly when the stakes are $20, you'll be slaughtered when the stakes are $500. The market is a scaling mechanism that magnifies who you are. Disciplined traders with small money become wealthy traders with big money. Gamblers with small money become broke gamblers with no money. In the next chapter, we'll take this R-based framework and apply it directly to the 1H chart. I'll show you exactly what a professional-grade pivotal point setup looks like, how to identify it before the market moves, and how to calculate position size so your risk is always exactly 1R, regardless of stop distance. The mathematics only work if the setups are clean and the execution is disciplined. Now we address the critical question that determines whether this entire mathematical framework succeeds or fails in real market conditions. What does that one high-probability trade actually look like on your chart? You can master risk management and understand compounding, but if you cannot distinguish genuine setup from market noise, you are still gambling with better discipline. Jesse Livermore called them pivotal points. These are specific price levels where the market stops hiding and reveals its true intention. At these levels, the balance of power between buyers and sellers gets tested decisively. Either the trend continues with institutional force, or it reverses with conviction. On lower time frames, these moments are buried under algorithmic noise, stop hunting spikes, and random volatility. But on the 1H time frame, Pivotal points become crystal clear because 60 minutes of market action filters out the chaos that destroys day traders. Think of the 1H chart as the zoom level, where randomness starts fading and intention starts appearing. One candle represents an entire hour of battle between buyers and sellers. Wicks tell you where price tried to go and failed. Bodies tell you which side actually won that hour. When you stack those candles around key levels, the market's story becomes readable to trained eyes. A genuine pivotal point on the 1H chart exhibits three non-negotiable characteristics. First, it is a level that price has respected multiple times previously with significant reactions, not just minor bounces. Each touch builds credibility that this zone matters to institutional money. Second, it represents a clear battle zone where buyers and sellers have fought for control, leaving behind rejection wicks, failed breakouts, and strong impulsive moves. Third, it sits at a logical structural location like a prior swing high, swing low, or major consolidation area that everyone can see. It makes sense. It has price memory. Professionals do not guess at these levels or draw lines hoping they matter. They identify the battlefield in advance and wait for the armies to arrive. That patience separates systematic traders from impulsive gamblers who chase every move. Here is the systematic protocol for execution. Memorize this, because it will protect you from 90% of bad trades. Step 1. Define your pivotal level before the trading session begins. If you are drawing levels while the market is moving, you are already reacting emotionally. Mark previous highs, lows, or consolidation zones that the market has clearly respected over recent days or weeks. This becomes your zone of interest, not your entry trigger. You are stalking, not shooting. Step 2. Wait for 1H confirmation. This is where amateurs get slaughtered. They see price approaching a level and immediately enter, trying to catch the exact reversal. They are predicting instead of reacting. You do not predict reversals. You react to them. You wait for the hourly candle to close and show you what actually happened at that level. Look for rejection wicks that show one side got overwhelmed. A long upper wick means buyers tried to push higher, but sellers crushed them. Look for strong closes away from the level after a test. Or watch for clean break and retest patterns where price breaks through, pulls back to test from the other side, then continues. A touch is not a trade. A reaction is a trade. Step 3. Place your stop loss beyond the pivotal level, not within normal volatility. Your stop should be positioned where your thesis is clearly invalidated. If you are shorting at resistance, your stop goes above the highest point of the rejection pattern. Calculate your position size so that the distance from entry to stop equals exactly 1R, your predetermined risk amount. If your stop needs to be 30 pips away for safety, you trade smaller size than if it needs 20 pips. The risk amount in dollars never changes. Step 4. Target a minimum of 2R, mapping your exit to the next obvious structural level. You are not using arbitrary profit targets. You are looking at the chart asking where price is likely to react next. That might be a prior swing point, significant consolidation zone, or round number with historical importance. If the next level only offers 1R reward, you do not take the trade. Let me illustrate with a concrete example. You are monitoring Eurist on the 1H chart. Over 2 weeks, you noticed price reverse 3 times at 1.0850 with strong hourly rejection candles. Today, price rallies back toward that zone. The amateur sees green candles approaching and feels FOMO. He enters at 1.0848, places a tight 10 pip stop to trade large size, and gets stopped out when price spikes to 1.0860 before reversing exactly as predicted. The professional watches differently. Price hits 1.0850 and pushes to 1.0862, but sellers overwhelm buyers in the final 20 minutes. The hourly candle closes at 1.0845, with a long upper wick showing rejection. That confirmed rejection is his signal. He enters short on the next candle open at 1.0845. His stop goes at 1.0865, above the rejection wick, 17 pips away. He calculates position size so 17 pips equals exactly 1R, his $20 risk. His target is the next 1H support at 1.0800, offering 45 pips or 2.6R reward. The math works. The signal works. he executes and walks away. This approach is not perfect. Even professionals lose trades when news events blow through levels or confirmation signals fail. But every trade has logic, location, and defined risk. Because he only seeks one setup per day, he can afford to wait for this level of clarity and confirmation. He is not exhausted from fighting lower time frames all morning. He is fresh, focused, and ready to strike when odds are heavily in his favor. In the next chapter, we will tackle the hardest part of this system, the part that destroys more traders than bad entries or poor risk management. How do you psychologically survive the waiting periods between setups? How do you resist taking 5 impulsive trades while your planned 1H setup slowly develops over agonizing hours? This is where most traders fail, and it has nothing to do with chart reading or technical analysis. They fail in managing the empty space between high-probability setups. The 1H timeframe demands something that is psychologically brutal for most people, extended periods of doing absolutely nothing while remaining fully alert for the right opportunity. This combination of stillness and readiness goes against millions of years of evolutionary programming that kept our ancestors alive. In the ancestral environment, sitting motionless while resources moved around you meant starvation or death. Our brains are hardwired to interpret inactivity as dangerous. When you see price moving on your screen, ancient survival circuits fire up, screaming that you are missing opportunities that could mean the difference between thriving and dying. In modern trading, the opposite is true. Constant movement leads to financial death, and strategic stillness is the only path to compound wealth. Consider the brutal mathematics of time on the 1H chart. Each candle represents 60 full minutes of market action. When you identify a pivotal level in the morning, price might be 50 pips away on Eurist or 60 points away on NASDAQ. It can take 3, 5, or 8 candles to reach your zone of interest. That means 3 to 8 hours of apparent inactivity. An entire trading day where your only job is to protect capital and wait for a line on the chart to be tested. For traders conditioned by social media dopamine hits and the instant gratification of lower time frames, this silence becomes unbearable. The psychological pressure builds predictably. Hour 1 passes with minor fluctuations that mean nothing. Hour 2 brings small patterns on lower time frames that whisper seductive lies about quick profits. By hour 3, your brain is manufacturing reasons why your original plan was too conservative, too rigid, too boring. This is when the self-sabotage begins. You start dropping down to 5-minute charts just to check the price action. You see a small consolidation and rationalize that you could scalp 20 points while waiting for your main setup. You tell yourself this is being adaptive and flexible, but you are actually just bored and impatient. Your criteria loosen subtly. That clean 1H confirmation standard becomes, well, the 15-minute looks decent enough. Here is the professional mental framework that separates survivors from casualties. Waiting is an active position. When your capital is flat and your risk is 0, that is your current trade. You are not sitting on the sidelines missing opportunities. You are strategically positioned in cash with full optionality intact. You are a sniper lying motionless in the grass, weapon loaded, breathing controlled, watching a target that has not yet walked into your crosshairs. Every substandard trade you take to relieve boredom steals capital from the high-probability trade that has not arrived yet. But it steals something even more valuable: your mental bandwidth. Your brain has a limited supply of high-quality decision-making energy each day. Every impulsive click on a 5-minute pattern drains that resource. By the time your planned 1H setup finally appears, you may not have the psychological capital left to execute it with precision. Let me walk you through a scenario that destroys accounts daily. You are monitoring NASDAQ futures with a marked pivotal level at a key resistance zone where price rejected violently twice in recent weeks. The market opens with price 80 points below your level, drifting sideways in morning chop. You are disciplined. You are ready. Hour 1 passes. Nothing meaningful happens. You check social media and see other traders posting screenshots of quick scalps on different instruments. FOMO begins its quiet assault on your discipline. Hour 2 arrives with more sideways action, but now a small bull flag appears on the 5-minute chart. Your brain whispers seductively, you could catch 30 points here while you wait. That is better than sitting here doing nothing. The amateur clicks by, sometimes capturing quick profits that make him feel brilliant for being flexible. More often, he gets chopped up in range-bound noise, losing money on a trade that never had real edge. Regardless of the immediate financial outcome, the psychological damage is done. His mental state is now compromised by either overconfidence from a lucky win or frustration from an unnecessary loss. When price finally surges to his original 1H pivotal level, hours later, with a perfect rejection candle, he is no longer the same trader who made that morning plan. He is tired from managing random positions. He is emotionally reactive from recent results. His decision-making cortisol is elevated. The one trade that mattered gets executed poorly, hesitantly, or skipped entirely. The professional experiences identical boredom and temptation, but responds differently. He acknowledges these feelings as passing weather, observing them without acting on them. He sets price alerts at his pivotal level, and then does something that feels counterintuitive. He walks away from the screen completely. He protects three critical resources that determine long-term success. First, his trading capital remains untouched by noise trades. Second, his mental bandwidth stays fresh for the decision that matters. Third, his ability to execute with clarity remains intact when opportunity finally arrives. When that alert pings hours later, he returns to his desk psychologically fresh, sees the setup clearly, and executes without hesitation or emotional baggage. This approach requires accepting a fundamental paradox of professional trading. Sometimes the most profitable action you can take is taking no action at all. The market does not operate on your schedule or emotional needs. It does not care that you cleared your calendar to trade today, or that you feel pressure to justify your screen time. The market reveals high-probability opportunities on its own timeline, governed by the interactions of millions of participants and billions of dollars. Your job is not to convince the market to move when you are ready. Your job is to be ready when it moves. This means building psychological infrastructure that supports extended waiting without self-sabotage. Delete lower time-frame charts if you cannot trust yourself around them. Set alerts and physically step away from the platform. Create ironclad rules that prohibit any trade not identified before the session began. Most importantly, reframe boredom as a trading signal. When you feel the urge to manufacture action, recognize that as confirmation you are in the right mental space. Boredom means you are not chasing. Restlessness means you are being selective. The discomfort of doing nothing while remaining alert is the price of admission to consistent profitability. Understand that professionals measure success differently than amateurs. Amateurs count how many trades they took. Professionals count how many bad trades they avoided. Every impulse trade you resist is a deposit into your long-term equity curve. Every time you choose strategic waiting over manufactured action, you are paying yourself in future compounding. In our final chapter, we will integrate everything: the mathematics of compounding, the 1H pivotal point protocol, and this psychology of strategic waiting. You will see the complete system that transforms $20 disciplined wins into $500 daily income through the boring, repetitive execution of a process that most traders cannot tolerate long enough to profit from. Now we synthesize everything into a complete, executable framework that transforms one disciplined trade per day into sustainable $500 daily income. This transformation happens not through prediction, secret indicators, or market timing, but through the systematic execution of a proven process that compounds over time, while most traders destroy themselves through impatience and overtrading. This is the bridge between understanding concepts and actually getting paid for disciplined behavior. We are building a personal trading machine made of rules, routines, and risk limits that, when executed consistently, scales your income naturally through mathematical progression rather than emotional gambling. Identity formation. Before strategy, before technical analysis, before you even open your charts, you must decide who you are in the market. This internal decision determines every subsequent action. You are not a scalper seeking constant validation through trade frequency. You are not a day trader trying to catch every minor swing for excitement. You are a 1H precision trader who takes one high-quality setup per day, or absolutely nothing at all. This identity shift is fundamental because it changes how you interact with the market at a neurological level. When your identity is active trader, every quiet moment feels like failure and missed opportunity. When your identity is precision sniper, every quiet moment, is strategic positioning and capital preservation. Your success is measured not by how many trades you took or how exciting your day was, but by process adherence and risk management consistency. Did you wait for confirmation? Did you execute your predetermined plan? Did you protect your capital? These questions matter infinitely more than whether you made money today. Risk framework implementation. Fix your risk at exactly 1% per trade, calculated in R multiples rather than dollar amounts. Write this percentage on a sticky note and attach it to your monitor. This number is non-negotiable law. It never changes because you had 3 winners and feel invincible. It never changes because you suffered 3 losses and want revenge. It never changes because you feel super confident about a particular setup. Your primary goal for the first 6 months is not growing your account or hitting profit targets. Your goal is proving to yourself that you can execute this risk model without a single deviation under all market conditions and emotional states. If you cannot control position sizing on a $2,000 account, you will destroy a $20,000 account within weeks. Account growth is merely a byproduct of risk discipline, not the primary focus. When you shift focus from outcomes to process, outcomes improve automatically because you stop sabotaging yourself with emotional position sizing. Market specialization. Choose 1 or 2 instruments for your 1H analysis and commit to them completely. Perhaps Eurist and NASDAQ futures, or gold and S&P 500, whatever liquid markets align with your time zone and temperament. Every instrument has a unique personality, specific rhythm, and characteristic ways of forming pivotal points and faking out traders. Specialization builds pattern recognition that generalists never develop. After watching Eurist for 3 months, you start feeling when a level matters before price even reaches it. You recognize setup shapes that lead to explosive moves versus those that chop sideways indefinitely. This intuition cannot be taught or rushed. It emerges from focused repetition on the same instruments until their behavior becomes predictable. Specialization also reduces cognitive load dramatically. Monitoring 12 instruments creates decision paralysis and dilutes focus. Monitoring 2 instruments creates clarity and depth of understanding. You are not trying to catch every move in every market. You are trying to catch the best move in your specialized market. Setup execution protocol. Each trading day begins identically, before market open and before emotions get involved. Mark your pivotal levels based on prior price action, using established criteria, levels with multiple prior reactions, clear battle zones between buyers and sellers, logical structural locations that make sense. These become your zones of interest for the day. Define your 1 or 2 possible trade ideas around those levels before price action begins. Long here if price reacts this specific way. Short there if price confirms that particular pattern. Your criteria must be specific enough that another trader could examine your chart and definitively say whether your setup criteria were met. Wait for 1H confirmation. Not predictions, hopes, or feelings. Confirmation means rejection wicks showing one side got overwhelmed, strong closes away from the level after testing, or clean break and retest patterns where price proves the level from both sides. You do not enter on touches. You enter on confirmed reactions. Place logical stops beyond the pivotal level where your thesis is clearly invalidated, not tight stops within normal noise designed to accommodate larger position sizes. Calculate position size so the distance from entry to stop equals exactly 1R, your predetermined risk amount. If the logical stop requires wide placement, trade smaller size. If it allows tight placement, you can trade larger size. The dollar risk never changes. Target minimum 2R reward, mapping your exit to the next obvious structural level that makes sense on the 1H time frame. Take 1 trade maximum per day. If your setup triggers, you are finished regardless of outcome. If your setup never appears, close the platform and wait until tomorrow. No manufactured trades. No boredom scalps. No exceptions. Compound growth management. As your account grows through consistent execution, position size naturally scales while risk percentage remains constant. This is where mathematics becomes your wealth-building partner. A $2,000 account risking 1% generates $20 R values, making 2R trades worth $40. At $5,000, R becomes $50, making 2R trades worth $100. At $10,000, R reaches $100, making 2R trades worth $200. At $25,000, R reaches $250, making single 2R trades worth $500. The structure never changes. Your discipline never changes. Your emotional stress remains constant because you are still risking the same percentage. Only position size grows with capital, and that growth happens automatically when you protect the process. The mathematical reality. Let me provide realistic timeline expectations based on verified calculations. Starting with $2,000, risking 1% per trade, achieving a 60% win rate with 2:1 risk-reward ratio, trading maximum 5 days per week. Expected value per trade, 0.602R plus 0.41R, 0.8R. With initial R value of $20, expected value per trade is $16. Over 20 trades, approximately 4 weeks, account growth reaches. Account value 2,000 plus 2016 through 320. Continuing this progression with compounding effects. Week 12, approximately 3,800. Week 24, approximately 7,200. Week 40, approximately 15,000. Week 52, approaching $25,000 where 1R6, 250. At this level, single 2R trades generate $500. Nothing magical occurs at this threshold. You have not discovered secret patterns or upgraded your intelligence. You have simply maintained identical discipline process with larger position size, allowing compound growth to handle the scaling. Your implementation protocol. Risk a fixed percentage never to be violated under any circumstances. Trade 1H pivotal setup daily at maximum, 0 if your criteria are not met. Treat waiting as an active position, preserving capital for quality opportunities. Let account growth increase R value over time, without forcing the process through over-leveraging. Create a written trading plan, documenting your identity, risk percentage, markets, setup criteria, entry and exit rules, maximum trades per day, and responses to consecutive losses. When emotions surge during live trading, pre-committed rules must be louder than market noise. The next logical step is building psychological infrastructure through trade journaling, reviewing every trade for process adherence rather than outcome, and developing mental toughness to execute the same systematic process for months, while others chase excitement and destroy accounts around you. Stay patient with the mathematical progression. Size appropriately for logical stop placement. Trust the process even when progress feels painfully slow. Let compounding, not emotion, build your trading income. The market rewards those who can tolerate systematic execution long enough for mathematics to work in their favor. If this framework resonates with your trading goals, the obvious next step is learning how to construct a detailed personal trading plan that protects this system during inevitable periods of market chaos and emotional challenge.